Good morning, everyone. Welcome to this update for global stocks and commodities for the 5th of May. The message this week is, and I guess this happens all the time when markets set new highs and people start thinking, well, 10-year bull market, we're at new highs. There's a lot of chatter about the market being overvalued. And so the logical conclusion, which is easy to come to, is that this bull market has got to end sometime soon, and there's got to be some sort of major crash to bring it all to an end. And that seems logical at one level, but the reality is something quite different. And people have actually been calling a top to this bull market for probably about 4 or 5 years, and it hasn't happened. So once again, we've set new highs, and all the chatter starts up again about the market is overvalued, but it really isn't the case. So that's the essence of today's video. So I just really want to look at the fact that there's plenty of evidence out there that the bull market is sustainable, and the bears absolutely hate this bull market. They've hated it since about 2012, and lots of people have stayed out of the market and have missed out big time. And what they're doing is they're really confusing logic with the reality of both where the economy is, because this has been a very slow and fairly painful economic recovery, and also the reality of where prices are going. And prices have been going up, and earnings are going up in the States. So it's very much a sustainable market. We'll look at the normal stock and commodity trend updates. Portfolio Analyst last week, there was just a huge number of questions, but I also provided just a perspective on this whole question about value and bear markets and all that sort of thing, which I think members found very valuable. Also, too, we're just launching call it a mini course, if you like, called Trading with Precision, not Prediction. And basically, I'll just swap screens here. So this is the login for or the registration page for this, and it's a taste of the course that members have access to in either the Insiders Club or in Portfolio Analyst. And it includes videos on what stocks are buys based on both fundamental and technical analysis. There's videos on how to avoid stocks that are likely to be losers, and that's just as important in knowing what to avoid. And there's also videos on how to take exits and profits, so stop losses and profits. And I find over the years, in having worked with literally thousands of people, that this is the technique, exiting, that nearly everyone struggles with. So I present some fairly simple to observe processes that I think will help you be much more efficient in taking your exit. So Portfolio Analyst, there's a $1 trial for 2 weeks. There is a link in the description below, and if you haven't tried it, I would really recommend it, because you'll find, I think, a lot of very valuable information in there. Okay, so let's move on. American stocks. The S&P gained 35 points for the week. And the word really on the street is that the market is overvalued, because it's gone up 17 of the last 19 weeks. And as I said at the start, it's sort of a logical, emotional kind of conclusion to come to, but it's really just not true. It's not overvalued. It might be overbought. In fact, it is overbought technically, but markets can remain overbought and oversold for many, many months before some of that pressure gets relieved. So the fact that it's overbought is just, an interesting piece of information. It's really nothing that should dictate any actions. So in my view, the market is not overvalued at all. There are some stocks that are, for sure. And I talked a bit about that last week in terms of some of these ridiculously hyped IPOs that are coming to the market. So some stocks are overvalued, but the market as a whole, no, it's not. So I'd really encourage you, don't sort of fall for that consensus thinking that that the market is gone up for so long that therefore it must be overvalued. That is not a logical conclusion. An earnings season in the US, which is really last week, I think was probably the biggest week of the whole earnings season in terms of numbers of stocks reporting, and that earnings season really indicates that forecasts are probably on the low side, and that forecasts are going to have to be raised. And if that is the case, then this market has still got plenty of legs in it yet, because stocks do respond to analysts raising forecasts. I mean, that's just a fact of life. I'd also add that in America, productivity growth, and you've got to be wary of taking short-term data points, but productivity growth has really shot up again in recent months, and it's up at 3.6% annualized, and that is a really strong reading. And when you consider that between 2010 and 2017 in America, productivity growth grew at 1%, then to be up at 3.6 is an amazing stat. And this is not GDP. This is productivity. This is how much output you're producing in the economy, relative to everything else that's going on. So, overall, it's I wouldn't call it rosy, but it's certainly well and truly good enough in America to sustain this bull market. US dollar down slightly last week, and the 10-year Treasury yield was pretty much steady, just above 2.5%. So let's take a look at the American stocks. So we'll start with the S&P, big picture, monthly chart. So the bottom here is 2009, and you can see that we've had quite an amazing run during that period of time. We had a pullback in 2011. We had another pullback at the end of 2015, start of 2016. And then, of course, we had a fairly significant pullback in November and December of last year. And then since then, we've just gone up, straight up for 4 months. Looking at this on a daily, you can see now we've now, it's only very marginal, but we had 3 levels to get to. This was the first level, which was some highs from October last year. Then the next level was the January 2018 highs. And then finally, the all-time highs have been overcome. Now, only slightly, so you could argue that we haven't really broken out yet, but it's certainly heading in the right direction. So that's the S&P, and you can see that it's just sustaining this gap above the 50-day moving average. And in fact, if I put a 20-day moving average on there, in fact, let me just change this to a 20. You can see that it's pretty much just hugging the 20-day moving average and sustaining itself above that. And the only time it went underneath it was when we had a few days of rocky selling in March. So it's been a really, really strong trend this year, that's for sure. Let me just change that one back. So certainly looking all good at the S&P level. Let's look at the Nasdaq. So the Nasdaq at new all-time highs, and has been for some time, and a lot of that is around the tech stocks, the tech sector. Amazon, Google had a bit of a setback, but certainly Amazon and Microsoft, Facebook and Netflix have been extremely strong. So technology is certainly where the leadership is in America. And if we look at the small caps, there's the Russell. So we're not up at all-time highs on the Russell. So the small caps are lagging to a degree, but look, they're not that far off their all-time highs. So as far as this particular ETF goes, we're looking at the current level of 160 as against a high of 172. So we're not that far off it. So very good breadth still in the American market, which is what's important. This is not just a rally being sustained by Amazon and Facebook and Netflix, etc. Here's the US dollar. So we've unquestionably got an uptrend. We got a breakout in the short to medium term. We've retested that breakout, and a little bit of weakness on Friday, but that's only very short term. Turning now to the Australian dollar, and you can see we're still in this downward sloping wedge that we've been in really since about October of last year. And we did actually have a minor break to the downside, got down to 69.9 on Thursday, and you've just got to say that the direction for the Australian dollar is to the downside. Now, yeah, anything is possible. This could easily rebound, but you can see it's been unable to get back above this declining trend line, which at the moment is probably sitting at about 71.5. So I think that will probably cap the Australian dollar on what we can see at the moment. Okay, turning now to the ASX 200. So we ended up down a bit, down about 50 points, I think, on the ASX 200. So we're still not above the highs of 2007, which were just around 6,900 points. But at least we managed to just inch above the August 2018 highs, which is around 6,350. And that is a lot about, certainly we've seen strength in BHP and Rio, although they have come off, as you can see, in the last few weeks. But also the banks sort of really defying the fundamentals, because the outlook for the banks is not great. And you can see we've had a good couple of weeks from the banks, but you got to note the NAB has cut their dividend. The ANZ result was pretty uninteresting, and some analysts describe it as poor. So it's going to be hard work for the banks from here. So just to recap, the Aussie dollar just a tick over 70 cents after a brief breakdown. Our index down 50 points, but it would appear, given the strong finish in the US market, that we'll probably see the ASX 200 move higher on Monday. And look, there's just no change to where the opportunities are. Most of them, there's very few stocks in the top 100 that really tick the boxes that I look for. Precious metals, gold was down $7 to $12.80, and we do seem to be finding support around the 1270 level. Buyers seem to be stepping up at that level, and that corresponds to an Australian dollar gold price of 18.25. And when you consider that most of the good mid-cap producers in Australia are somewhere between $1,000 and $1,200 an ounce, that gives them a $600 to $700 profit margin. So that's why the local gold stocks have been doing so well. Whereas in America, most of the majors have costs somewhere between $800 and $1,000 US. So they're looking at profit margins of only a couple of $100. So that's why the Australian gold sector has done so much better. GDX is down over the last week or two, but really when you look at it, it's really, there's underperformance by Newmont Mining. Newmont Mining is being sold off more heavily than some of the other majors. So Newmont is the second biggest, I think, in the world. Barrick Gold, which is the largest, has been looking relatively better. So this is, whilst the GDX is struggling, this is in part a stock-specific issue with GDX, because Newmont has a significant impact on GDX because it's such a large stock. So there's some sector-specific, some stock-specific stuff going on in that sector. So GDX, the gold mining, gold stock sector is not as poor as it looks. And the other point that I made last week is that there's a major acquisition cycle is underway globally. It hasn't really impacted here yet, but the local mid-cap producers, so Northern Star, Evolution Mining, Saracen, Regis, those sort of stocks, are likely to be touched at some stage. Now, you shouldn't buy and you shouldn't hold a stock because of it's a possible takeover target. That's a very unwise strategy. So you should see this as a bit of cream on the top if it were to come along. It could be, a year or more, but I would be just surprised if one of the Australian or more of the mid caps didn't get an approach from some of the US majors, because they've got two choices. They've either got to spend a massive amount of money on new exploration, or they've got to buy some more ounces because they're running out of ounces at a big picture level. So, this acquisition cycle is not based around speculation. It's based around necessity. Turning to other commodities, copper was down to 283, and I think that's in part responding to some less than robust data out of China, and of course Europe is still facing their struggles. And also, as we'll see from the chart, there's a bit of a rising inventory building up in the London Metals Exchange warehouses as well. And that's that generally has an inverse relationship with the copper price. Crude oil, WTI crude slipped just below 62, and that caused energy stocks to fall fairly sharply. So there's the spot copper chart. You can see the dip over the last week, and there's those LME 1 year copper inventory levels have spiked up quite a bit from about 120,000 tonnes up to almost 240,000. So we've had an almost doubling of the inventory level. Just for perspective, the peak tends to be around 500,000 tonnes. There's the crude oil chart, so you can see we've come off the boil a fair bit. There's a few things going on there, a few geopolitical things going on there, but that's the crude oil chart. Now I'll just go back and cover a couple of things. So I didn't look at gold. So there's the gold price. You can see it really hasn't come off too much at all. We still need to get above this 1380 level to break into a new uptrend, and that's proving to be hard to get. If we look at a daily chart, you can see we're definitely in a declining trend channel since February. So things were looking really good at February. We've now had a partial pullback, but we still are within this overall uptrending channel. Now we broke out of it to the upside, so it got ahead of itself. We've now pulled back to the bottom of the channel, and we are finding pretty ready support here at 1270. So I think as long as that level holds, then we're still going okay with gold. And just looking at GDX, this is on a weekly chart. You can see GDX probably looking a little less robust than the gold price, but as I mentioned, that's certainly an impact from Newmont Mining is doing that. And just on the energy side, so this is XLE in the States, which covers basically the whole energy sector, explorers, producers, pipelines, refineries, and all the drilling sector. So that's the whole shooting match there, and certainly had a pretty ordinary week. So to wrap it all up, the conditions in America, in a sense, at a big picture level, are close to ideal. Now, I put ideal in inverted commas, but it really is sort of a Goldilocks situation, because if everything was great, then the central banks would be raising interest rates, and the stock market would be taking notice. But it's ideal in the sense that it's a solid economy. Yes, there's a few areas you can point to, but it's solid enough. Inflation is really and truly under control. So the inflation is only quite minor. And we've got this rising productivity. So, I mean, this is just a central banker's dream to have the combination of those three things at a big picture level. And, what came to mind for me is leading into the election we're having here in Australia, where there's just we're not moving any closer to taxation reform in any sense. And I just wish that our politicians on both sides and unions could consider what the tax cuts have achieved in America, because this position that America finds themselves in is not. It just didn't happen by chance. And whether you like Trump or you hate Trump, there's no question that he has made a significant positive economic benefit to America. There's no question at all. Now, there's some social issues that need addressing, but from a purely economic point of view, Trump has definitely turned America around. Now, there's a bit of collateral damage goes with that, but I just see Australia not being in step with the rest of the world, and we're very, very much at risk of losing our competitiveness. Anyway, that's my soapbox for the morning. And secondly, in America, despite the new highs, you would expect that sentiment would be through the roof, but it's actually not. It's still only tracking, the bullish sentiment is still only sitting about 39%, which is about the long-term average. So it's not like the sentiment has gone right up there, and that tends to make the market advance unsustainable. The fact that sentiment is still where it is at the long-term averages just reinforces the fact that this rally is sustainable. So therefore, one would have to conclude, in the absence of any particular trigger, that pullback should be fairly mild and fairly brief. And I think that's the outcome that we're going to see in the absence of any other significant trigger. Like, I guess the obvious one is if the US-China trade negotiations completely fall apart, that could be a trigger. Portfolio analyst this week, I'll be introducing another local stock that has got enormous potential upside. So there's a lot of exciting stories in Australia. It's really just a matter of making sure you don't jump into them at the wrong time, because certainly these stocks, whilst they've got enormous upside, have also got the potential to fall 20, 30, 40% before they go up. So, you've got to have a pretty robust game plan built around this. So that'll be Portfolio Analyst this week, and we're just getting a ton of really good member questions as well for analysis. There's my contact details for anyone that has not tried the Portfolio Analyst trial or is not a member of my current services. And let's look forward to what the upcoming week will bring. That's it for this week. Cheers.